And we found 22 firm or strong indicators suggesting employment and inflation might linger at a higher than expected rate. We found 22 weak indicators. Now, pulling out the ones that are specific to employment and inflation, since those are the two variables that the Fed is weighing more than any other. And we find that on the firm side, what they didn't like was core CPI and PCE at 0.6% month to month, even though the headline indicators were flat to down. The PPI core 0.4, and non-farm payroll, which came out today, pretty much in line, 263,000, but there was a drop in the unemployment rate from 3.7% to 3.5%. Now, the reason for the drop was the labor force, not employment. The labor force shrinking. Labor force participation ticked down. So I don't take that reason as seriously, because we do believe labor force participation will, on balance, continue to trend up, especially if we're in as weak an economy as we believe. So on the weak side, again, if the Fed were data driven, it would be paying attention to employment in the ISM index for September. Below 50% means it's contracting. The job openings, so JOLTS, they dropped 1 million in 1 month. Now still strong at 10 million. They dropped 1.1 million. That's a big drop in just 1 month. So job openings are declining. We're also seeing surveys out there, I think, in the U.S., among major employers, 300 have announced layoffs, and that's reflected in something called the Challenger Layoff Survey. And those layoffs, which are broad-based company layoffs, are up 68% year over year. I would also imagine that they would consider leading indicators, which in every recession and recovery, in my experience, the Fed has paid a lot of mind to. It dropped 0.3% in the last month, and that makes for 5 consecutive months of decline. And the rule of thumb there is once you've got 3, you know you're in a recession. So the Fed may be saying that it's data dependent, but it's looking at the data it wants to look at. It's not looking at the totality here. It's also making an assumption that we think is mistaken. It's very much a Phillips curve Fed. Now that's a very Keynes economic theory concept. And it basically says that rising output and employment causes inflation, or at the very least, highly correlated. And that's just not true. If you look at the data, 80s, 90s, 2000s, you'll see that inflation came down during times when the economy was very strong. Why? It's because of productivity. Productivity growth is a byproduct, a critical byproduct, and an anti-inflationary byproduct of good, strong recoveries. So, we shall see. All right, on to, and I'm going to refer to some numbers here that my colleagues prepared. So let's go to the commodity prices. Again, data-driven Fed. Are you listening? So we'll start with, from their peaks, we've got gold price, the gold price down 17%, copper down 30%, lumber down 73%. Think about that. Housing is collapsing. Iron ore down 45%. Infrastructure around the world has run into trouble, especially China. Corn down 17%, silver down 29%. DRAM prices, which are chips, semiconductors, down 46%. The Baltic Freight Index down 48%. That's an indicator of supply chain issues. The Baltic Freight Dry Index, which is just for dry goods, down 65%. Oil down 29%. And many people have been dismissing these and saying, yeah, but that's, they went to sky-high prices. They're still not down on a year-over-year basis. That's not true anymore. Gold is down 3%. Copper is down 17%. This is as of today. Lumber is down 28% on a year-over-year basis. Corn is an exception. It is up 27%. Again, Ukraine being a big problem there. We have silver down 9%, DRAM prices down 33%, the Baltic Dry Freight Index down 65%, and oil and corn. Oil is up 14%. That's as of today. It's had a big pop recently, but we do think, having come down from $130 to $90, it is in a downtrend, mostly because of demand destruction. There's another kind of esoteric price out there. I remember it from my days diving deeply into economics, and it's container board prices. This gives you a sense of, how tight the box market is because of a huge amount of trade taking place. So they are down 29% from their peak and about 53% from a year ago. So just taking the evidence and putting it together like this, there is a lot of data to be driving the Fed, which is what they say is happening, but we don't think it's happening. I just rattled off lots of examples. So let's go to the markets and then wrap up pretty quickly here. Not much to say. No, markets are selling off across the board, and that's very unusual. It's associated with crises. And more convincing evidence to us that the Fed is too tight and that it will pivot. And when it does, it will do so, we think, significantly. Now, first, it might simply be rhetoric, because they always like to tee us up for what the next moves are going to be. And we haven't heard that rhetoric yet, despite all the evidence I just shared with you. But that evidence I just shared with you tells us that the Fed is going to get the message loudly and clearly somehow. And it may not be showing through in the numbers they want to see, but it will. It will. They are huge lagging indicators. They're basing policy on lagging indicators, not what they're supposed to be doing. Anyway, if you take, in the US alone, if you take equities and bonds and look at what's happened since the peak, you will see that the loss to investors is more than twice what we saw in 08-09. That's how bad this is, because bonds are selling off with stocks this time.